Consider the story of a 72-year-old retired machinist from Dayton, Ohio, who spent 41 years on the job. 3 years ago, he experienced the heartbreaking loss of his wife. When his bank finally presented a competitive 4% rate last January, he decided to transfer his entire life savings of $155,000 into a certificate of deposit. He left every cent untouched, choosing not even to withdraw the earned interest. Yet, when spring arrived and he opened his tax return, he was shocked to find a bill for approximately $1,400. Just 1 year prior, his tax liability was zero, despite receiving the exact same Social Security check and maintaining the same modest lifestyle. The sole variable was the location of his savings. What most people never find out is that a specific financial boundary exists. For a single individual, the Internal Revenue Service establishes a combined income threshold of $25,000, while the limit for a married couple sits at $32,000. The moment your accumulated savings interest pushes your income past that boundary, that very interest becomes subject to a double tax. It faces taxation initially as interest income, and then it strikes a second time, because every single dollar over the limit can drag up to 85 cents of your hard-earned Social Security benefits onto your tax return. This mechanism can result in up to a 40-cent tax on every single dollar your savings generates. Under the current legal framework, no institution is mandated to inform you of this reality. You will not receive a warning from your banking institution, the Social Security Administration, or the Internal Revenue Service. The burden is entirely on you to recognize where this boundary lies, but it is entirely possible to calculate your exact threshold down to the penny. A clear understanding of this system boils down to three primary elements. First, it is crucial to recognize the three specific types of revenue the Internal Revenue Service leverages against you that catch nearly everyone off guard, which includes interest you have not even touched, and a specific category of income that is traditionally labeled as tax-free. Second, there is a particular checkbox on your tax documents that completely eliminates your exemption threshold by dropping it all the way down to zero, a detail that married couples absolutely must understand. Third, you can learn the precise vocabulary to use when speaking with your bank, alongside the specific government document designed to ensure you are never blindsided by an unexpected April tax bill again. Rectifying this situation does not require hiring a legal professional, consulting a financial advisor, or paying any specialized fees. It simply demands proper information and a single telephone conversation. You might currently be dismissing this warning based on a few common assumptions, but these misconceptions deserve a closer look. You might assume this does not apply to you because you are not wealthy. However, remember that the boundary rests at $25,000, and half of your Social Security benefits are counted directly toward that total. Given that the average monthly benefit check in 2026 hovers around $2,071, half of that annual sum positions you remarkably close to the threshold before your savings accounts even generate a single dime of interest. You might also believe your local bank would have alerted you to this issue. While the bank certainly communicated, their communication was directed straight to the government via Form 1099-INT, which automatically discloses your interest earnings every single year. Explaining how that disclosure impacts your federal benefits is simply not the bank's responsibility, so the warning goes unsaid. Furthermore, you may have heard rumors that recent legislation eliminated taxation on Social Security benefits entirely. This is incorrect. The new law actually introduced a highly beneficial deduction that you should absolutely utilize, but the underlying calculations used to tax your retirement benefits remained completely unaltered. Finally, if you feel it is too late to act because your money is already locked into certificates of deposit, take heart. Two distinct remedies remain perfectly viable for the current calendar year. If this perspective feels overstated, consider official data from the Congressional Research Service. This internal legislative research body reports that approximately half of all individuals receiving Social Security benefits are now required to pay federal income tax on a portion of their monthly checks. When this system was originally instituted back in 1984, it was projected to impact only about 1 out of every 10 recipients. The dramatic shift to 50% of beneficiaries was no statistical fluke, and understanding the underlying mechanism reveals exactly how it happened. The entire calculation is surprisingly brief, spanning just 3 lines on an Internal Revenue Service worksheet used to determine your total combined income. On line 1, you aggregate your alternative revenue streams, which encompass pensions, traditional retirement account withdrawals, and every single dollar of your accumulated bank interest. On line 2, you enter your tax-exempt interest, a number you should pay very close attention to. Even the supposedly tax-free municipal bond interest recommended by a financial broker must be added back into this equation, because on this specific worksheet, tax-free revenue still counts against you. On line 3, you calculate exactly half of your annual Social Security benefits. When you total these 3 lines as a single filer, and the sum exceeds $25,000, a portion of your retirement benefits becomes subject to taxation. Once that total surpasses $34,000, up to 85% of your benefits can be taxed. For those who are married and filing a joint return, these critical transitional lines are set at $32,000 and $44,000 respectively. The underlying catch that catches nearly everyone off guard is that these specific financial boundaries were established in 1983 and 1993. Throughout more than 4 decades, they have never once been adjusted to account for inflation. While your monthly retirement benefits receive regular cost of living increases, such as the 2.8% upward adjustment implemented this year, the tax boundaries remain completely stationary. Consequently, every single benefit raise gradually pushes you closer to a tax line that was originally drawn back when a gallon of gasoline cost a mere $1. The authorities are well aware that they face no legal mandate to update these figures, so they simply leave them alone. To see how this functions in real-world scenarios, we can analyze the math using actual figures. Consider a 69-year-old single woman named Ruth who receives $24,000 annually from Social Security. Half of that amount, or $12,000, is factored into the equation. She also receives a modest pension of $20,000 and maintains $45,000 in certificates of deposit yielding a 4% rate, which generates $1,800 in annual interest. Her computed combined income lands at $33,800. Within this specific income bracket, that $1,800 of interest does not just face taxation on its own merits. Generally speaking, every dollar she earns above the threshold pulls an additional 50 cents of her retirement benefits into the taxable category. As a result, her $1,800 in interest forces roughly $900 of her own Social Security onto her tax return, turning $1,800 of raw earnings into $2,700 of taxable exposure. Within the 12% tax bracket, this creates a liability of roughly $324 on a 4% certificate of deposit, which translates to an effective tax rate of 18% on her savings. Her money is effectively being taxed from multiple angles. Alternatively, look at a married couple, Earl and Dot, who bring in $42,000 a year in retirement benefits, meaning $21,000 is counted toward their threshold. They also pull in $25,000 from retirement account withdrawals and hold $155,000 in savings at a 4% rate, yielding $6,200 in interest. Their total combined income reaches $52,200, pushing them well past the upper $44,000 threshold and directly into the 85% exposure zone. In their situation, every single dollar of interest drags an additional 85 cents of benefits along with it. Consequently, their $6,200 of savings interest balloons into $11,470 of taxable income. Falling into the 22% tax bracket, this results in a tax bill of $2,523, meaning they are paying 40.7 cents in tax for every single dollar their savings account managed to earn. This makes it clear that being taxed twice is a literal reality of how the government worksheet was engineered to operate. It is vital to remember the hidden trap within this system regarding certificate of deposit interest that you never actually withdraw. For the majority of certificates with terms extending past a single year, the earned interest is automatically disclosed to the government on an annual basis, regardless of whether you touch the funds or leave them in the account. The money remains completely stationary, but the tax liability accumulates anyway. Determining exactly how much money is safe to keep in your standard savings accounts requires a simple division formula to find your personal boundary. Start with your primary threshold, which is $25,000 for single individuals or $32,000 for married couples, and subtract half of your annual Social Security benefits. Next, subtract your pension income and any retirement account withdrawals. Take whatever remaining balance you have and divide it by your current interest rate. At a 4% rate, every $25,000 of savings produces $1,000 of counted income. If you find you have $5,000 of remaining headroom, your maximum savings line sits at roughly $125,000. If you have absolutely no headroom left, every single dollar placed into a new certificate of deposit could wind up working against you at that costly 40% tax rate. If you are a single filer assuming your numbers are far too low to mirror these scenarios, do not overlook the next detail, because the system frequently deals the heaviest blow to individuals in specific situations. You are highly vulnerable to this hidden tax if you are a widow or widower filing an individual return, because your threshold plummeted from $32,000 down to $25,000 the year following your spouse's passing, even though your daily living expenses likely remained unchanged. You are also at risk if you initiated your very first retirement account withdrawal this year, finally transitioned your money out of a low-yield checking account into a certificate of deposit that pays a real return, or if you receive monthly interest payments from tax-free bonds. Any one of these events can easily push you over a regulatory line you never knew existed. There are 3 common myths that frequently prevent retirees from investigating their situation. The first myth centers around a sense of personal shame, causing people to believe that owing money means they must have made an error on their tax forms. In reality, your filing is likely perfectly accurate. The government simply froze the threshold back in 1983 so that natural economic inflation would quietly expand the tax base without requiring legislative changes. Your math, your pride, and your integrity are not the problem here. The second myth is rooted in fear, specifically the worry that moving your savings around will trigger an audit or flag your account with the authorities. Moving your own fully insured bank deposits between financial institutions is generally a non-taxable event that does not raise any red flags. The money belongs entirely to you, and while the banks hold it, you retain full authority to direct it. The third myth stems from personal pride, as many people assume that because they have successfully managed their own tax returns for 50 years, they would have easily spotted this issue. However, the Social Security Benefits Calculation Worksheet is an 18-line process deeply buried inside Internal Revenue Service Publication 915. It was never designed for easy visibility. It was simply written to be executed. Consider the brief case of Helen, a 75-year-old widow living in Tucson. Her financial professional directed her investments into municipal bonds under the assumption that they were completely tax-free, allowing Helen to bring in $6,000 a year in interest. Yet on the government worksheet, all $6,000 of that interest was counted, which ultimately pushed roughly $3,000 of her retirement benefits into taxable territory. This cost her approximately $36 every single month just for holding an investment marketed as tax-free. The promotional brochures never mentioned the underlying worksheet, and they were never going to. Fortunately, there is an advantageous twist that the government will not proactively mail you about. For the tax year spanning 2025 through 2028, a new legislative deduction has been introduced that offers up to $6,000 per person for individuals aged 65 or older, or up to $12,000 for a qualifying married couple, which is applied on top of your standard deduction. You can claim this benefit directly on Schedule 1A. For a substantial number of middle-income retirees, this single deduction can completely eliminate the exact tax bill generated by the benefits worksheet. To be completely precise, this deduction generally begins to phase out once income surpasses $75,000 for single filers or $150,000 for married couples, and it is set to expire entirely after 4 tax years at the end of 2028. You will never receive an official notice telling you to claim this deduction, as no such notification system exists. Understanding how this machine operates is only valuable if you take the time to run your own specific numbers. You can accomplish this tonight by following 3 straightforward steps that take just a few minutes. First, gather your tax return from the previous year, alongside every Form 1099-INT sent to you by your banking institution. Run the 3-line calculation by adding your alternative income to your tax-exempt interest and half of your Social Security benefits, then compare that sum to your baseline threshold of either $25,000 or $32,000. This will show you exactly where you stand, providing clarity that no outside institution was going to offer. Second, contact your bank and request a comprehensive list of every account linked to your Social Security number, along with their respective certificate of deposit renewal dates and the precise interest amounts they intend to report to the government this year. The stakes are high because allowing a certificate of deposit to automatically renew without reviewing it is essentially a vote to duplicate your current tax liabilities next year. Always verify the terms before agreeing to a renewal. Third, implement a protective strategy. If you discover that you will owe taxes, submit Form W-4V to request that the Social Security Administration automatically withhold taxes from your monthly benefit checks at a rate of 7, 10, 12, or 22% based on your preference. This effectively prevents April from becoming an unexpected financial ambush and generally protects you from underpayment penalties. When you file your final return, make sure to claim that $6,000 senior deduction on Schedule 1A. Both of these documents are completely free and take only minutes to handle. If navigating these forms or calculations feels overwhelming, consider asking a child or grandchild to assist you. It is a simple 15-minute favor that could easily save you a few $100s annually. Completing these 3 steps puts you ahead of roughly half the country. Before adjusting your tax return, it is crucial to address the specific $0 checkbox mentioned earlier. If you are married, do not file your documents before understanding this exception. The previous examples assumed a threshold baseline of $25,000 or $32,000, but there is one specific group of people whose baseline drops entirely to 0. If you use the married filing separately status and cohabitated with your spouse at any point during the calendar year, your threshold is not merely reduced, it is entirely eliminated. In this scenario, up to 85% of your retirement benefits can become immediately taxable starting from your very first dollar of income, representing a sudden financial trap rather than a gradual phase-in. Many couples choose to file separate returns simply to keep their personal finances organized, meaning they sit at the same kitchen table while the Internal Revenue Service reduces their tax-free benefit allowance down to 0. It turns out that personal relationships are not a tax-deductible category. No legal regulations are being violated here. You would simply be paying a penalty for not understanding the nuances of the tax code. A single checkbox ticked in good faith can end up costing a couple far more than an entire portfolio of certificates of deposit would ever earn. If separate filing has ever been recommended to you, checking that specific worksheet is the very first thing you should do before that box gets marked. You can prepare to make 2 critical phone calls by gathering a pen and paper. Your first call should be directed to your banking institution using the phone number printed on the back of your debit card or at the top of your financial statement. Try calling in the middle of the morning between Tuesday and Thursday, when hold times are traditionally at their shortest. Your first line of inquiry should compel a complete financial overview by stating, "Please read me every single account currently tied to my Social Security number, along with the exact amount of interest you intend to report to the IRS on Form 1099 this year, including any certificates of deposit that have not yet reached maturity." Your second phrase is a strategic statement that serves as the core solution. On any certificate of deposit with a timeline of 1 year or less, I want the earned interest credited exclusively at maturity, allowing me to choose exactly which tax year that income lands in. To be completely precise, certificates of deposit with terms exceeding a single year are legally required to report interest on an annual basis regardless of your preferences. This is a fixed banking regulation embedded in the deposit agreements that representatives rarely read aloud to customers. However, this timing strategy works perfectly for short-term accounts, and short-term certificates of deposit are currently offering yields that are highly competitive with long-term options. Your third line of inquiry looks backward to address past overpayments. If I happen to have missed a valid deduction or over-reported my past income, I intend to file Form 1040-X. This represents an amended tax return, which generally allows you to look back across the previous 3 years. If you previously skipped the senior deduction or paid taxes on retirement benefits you did not actually owe, that money belongs to you, and the responsibility to request a refund rests entirely on your shoulders because no official entity is going to initiate that process for you. If the customer service representative claims they cannot access that information or states that it is not a service they provide, avoid arguing. Instead, use this protective counterphrase. In that case, please transfer my call directly to deposit operations or mail me a copy of my official deposit agreement alongside a year-to-date interest summary, and I will gladly hold. The representative is simply following an internal script, but you have the right to guide the conversation. Conclude with a fourth specific request. Please ensure that this information is sent to me completely in writing, either via physical mail or a secure digital message, before any of my accounts undergo automatic renewal. Your second phone call should be made if you decide to establish tax withholding from your monthly Social Security checks using Form W-4V. You can download this document directly from the official IRS.gov website, or you can contact the Social Security Administration directly at 1-800-77-21213. The ideal time to place this call is early in the morning during the middle of the week toward the end of the month. A good rule of thumb for both conversations is that if an answer feels incorrect or confusing, simply hang up politely and place a new call. Once you receive 2 matching answers from different representatives, you can confidently proceed. Moving forward, there are 3 critical errors you must actively avoid. First, never allow your certificates of deposit to automatically renew without reviewing the terms, as blind renewals simply invite a repetition of the previous year's tax liabilities. Second, avoid purchasing tax-exempt bonds solely to bypass the benefit calculation, as the underlying worksheet factors that interest into your total income anyway. Third, never skip out on claiming a valid $6,000 senior deduction simply because you did not receive an official notification in the mail, because that notice was never going to be sent. Returning to the story of the machinist named Frank, there is an important conclusion to his situation. The $1,400 tax bill he incurred last year is gone permanently. It was legally owed under the framework of the tax code, and no amount of phone calls can recover past funds. That is the stark reality of the situation. However, this year, Frank took 15 minutes to sit down at his kitchen table with his granddaughter to calculate the 3-line math worksheet. He successfully claimed the $6,000 senior deduction, which caused his outstanding tax liability to drop to nearly nothing. He also submitted Form W-4V to eliminate any potential for an unexpected April tax bill, and he strategically divided his $155,000 savings portfolio into a ladder of smaller certificates of deposit with specific maturity dates that he chose deliberately, ensuring the interest would land exclusively in the calendar years of his choice. He utilized the exact same bank, maintained the same total savings, and received the same Social Security benefits. The transformation in his financial situation was not a matter of luck, professional legal assistance, or exploiting complex loopholes. It was simply the result of taking 15 minutes to understand the right questions to ask. You can take control of your situation tonight by reviewing your previous tax return, gathering your Form 1099 statements, and completing those 3 simple lines of basic arithmetic. If you or someone you know has been in this situation, consider passing this information along to a friend, a widowed sibling, a former colleague, or a neighbor who recently mentioned their new savings rate. By sharing these insights, you are not just passing along information, you are potentially saving them hundreds of dollars every single year. If this is a step you are preparing to take, or if this is something you have been dealing with, share your thoughts on navigating this worksheet. You are certainly not alone in this process.